All right, so welcome back, guys, to our today's Forex Foundation session training. Right, so I want to believe that everyone here has been part of the previous class, and I know some new people and new persons has joined us just recently, and I also know that most of them have missed the previous class. So we are going to start right away. I think we have the number that is okay for us to start the class for today. Every other person will join us at the middle. So today's class is going to be a little bit more of interaction because I've seen some questions. I've seen some reactions in the groups, in the DMs, direct messaging. Several questions have been asked, and I've realized that most people are just purely beginners. They're just coming into this training for the very first time. So there's so little and basic stuff they need to understand. And again, so I'll be answering some questions before we start today's class. We're not going to start from the beginning. We're going to start from where we stopped the last section, which was the second session. This is the third session. We are holding this training for this month and for this quarter, right? So we're going to do a little bit of interactions, and then while we move forward to where we stop. First of all, okay, remember, if you were here on our last session or you watched the previous video, because the video was made available, if you can remember where we stopped, can you just let me know? If you were here or you watched the last video training that we had and you remember where we stopped, can you just let me know? Okay, Victor. Victor, you can speak. You're being unmuted. So I'll unmute you guys. You can mute yourself from your end if you're not speaking. But yeah. All right. So Victor, can I hear you?
Yes, sir.
Are you with us? Yeah. You wanted to say something?
Yes, sir. Can you hear me?
Yeah, I can hear you clearly.
Yes. You said something concerning your previous teaching.
Please be a little bit audible.
So then I said that I didn't follow it up right.
I cannot hear you. Be a little bit of audible. Sorry.
Be able to follow the live. I said then.
Yeah.
I wasn't able to follow it up live.
Okay.
What you saying to us on WhatsApp? Then I joined the lesson, the session 1 and session 2.
So I think I'm struggling to hear you, but if I can hear you clearly, you said you're just joining us this week, if I don't make a mistake, right? Okay, Victor, I think you have a problem with your audio. You can write us on the comment section. Write us on the discussion group. Okay, check the channel. You'll see a comment section, so you can write it there. I'll read that to understand. Your audio is quite poor for us to hear. Emmanuel Godwin, you're welcome joining us. All right, so please, if you're here for the first time, we'd like to know who is here for the very first time. If you're here for the first time, you can lift your hands or you can speak. Let me know. I'd like to know, recognize you or not. Okay, Victor, you're here for the first time. I think I know that. Who else is here for the first time? Please. Okay, so we'll go straight to the class. So if you missed the beginning session of this training, you have to go and watch the previous videos. The session 1 and session 2 video is very important. You need to go and watch those videos. So I think we stop at fundamental and technical analysis. If that's where we stop. So during our last class, I had already defined what fundamental analysis are and what technical analysis are, right? So I said that in fundamental analysis is a form of trading that most trader uses to make trade decisions. When you're making trading decisions based on economic data, micro and macroeconomic data, um, you are basically doing a fundamental analysis and a fundamental form of trading. In other words, fundamental trading or forms of trading is also called news trading, which that means is you trade the news data. There are several kinds of news that we look at in the forex market. Um, while we trade, it's not all the news, but they are basic and more important news that we look at in the forex market, and we trace the news data. So in the course of our day trading, we'll be able to see how we analyze news, news impacts, both positive and negative drives the market. So, for example, if there's a news about US dollar or a news about, um, let's say, inflation rates in the US, that's going to affect the US dollar, you know, whether it is received or what it is the central bank is doing, it's going to affect the currency strength, either positive or negative. As a forex trader, you are to use that data to make the trade decision. So in either way, like I mentioned previously, that in forex trading, you can make money in both sides, whether the market is selling or the market is buying. So whether the market is positive or the market is negative, you can make money through these, forms of trading. So your own rule is to be able to know what going to be the impact of that news. Is it going to be negative or positive? And that's going to help you make your trading decision, either to go and buy any underlying asset or to sell off any underlying asset and make profit over that. So as we progress, you're going to understand what types of news that we look out for, or what types of data that we look out for in the forex industry, to use that as a strategy to trade the forex market. And I also mentioned that technical analysis is all about using the technical tools, just like it implies. It's the most popular form of trading. And why is the most popular form of trading is because when you're a news trader, you don't have high impact news oftentimes. So we have low impact, high impact. And in the beginning of this training, we talk about market participants, where we talk about speculators, we talk about retail traders, we talk about central banks, the government being participating in the forex market, the large commercial institution participating in the forex market, and they are the major player in the market. In some cases, they call them market makers. So these are the people that make price move, right? And so they are the major player in the market. So in some cases, we have a low impact where data comes out, news comes out, and they are low impact. We have some that are high impact. What that means is, if it's low impact, it means that it might not have a significant effect in the market. It might not really cause any form of volatility in the market. On the other hand, the high impact news simply means that it's a news that that's going to carry high volume, high liquidity, because it's a major kind of news. Most that kind of news is one of them is NFP, non-farm payroll. It's one of the major news. Every first Friday of every month is where the U.S. government, Department of Bureau, releases, the central bank releases this data, that carries a lot of information about the performance of the economy and the state of the economy of, and the currency performance like US dollar. Majorly, that news is about US dollar. So this is the form of trading that we engage on. Like I said, also, one is not bigger than one, and one is not used in isolation because it's a confluence. You need these two forms of trading to be able to, build a strategy and make the right trading decision oftentimes. So technical analysis is when you're using charts, trading charts, and you're using indicators, trading indicators. You're using maybe automated indicators, whatever it is, moving averages, some of these volume tools, Fibonacci retracement. You're using trend lines. You're using support and resistance. You're using price pattern, and in some cases, you build a different strategy around all of this, and you use this on your daily trading activities to make trade decisions, whether to buy or to sell, right? So in a short while, we are going to see some of this illustration, and we're going to be dealing more importantly on the technical analysis and both the fundamental analysis. So let's go, guys. So yeah, let's talk about a few things that you hear as we progress on this training. So you hear something like buy, you hear something like sell, you hear something like ranging, uptrend, downtrend, consolidation. So take notes of this vocabulary. It's widely used in the Forex market. Buy, sell, ranging, uptrend, downtrend, consolidation. So if you're new and a beginner, you want to have some of this word in your head. We will talk about them, what it means. So first of all, in the Forex market, we buy any asset, a currency pair against another, and we also sell any currency pairs against another. And when we talk about ranging, ranging is a form of market that is going sideways. What that means is the market is not going up, the market is not coming down. So what that happens is the market is in a range, a certain price level. Let's say, for example, let me use a bag of Gary in Nigeria here. It's sold for probably, if I don't make a mistake, it's about maybe 90,000 naira, or maybe it's something
Yeah.
thousand naira. So let's say you went to buy today
I can't
and the
pin.
market, the price is like 95,000. You go to another supermarket and the price is like 98,000. You go to another supermarket, the price is like 92, 93,000. So between 90,000 and 100,000 is is where the range is. It's not breaking out to sell above 100,000. It's not selling below 90,000. So you find these prices in the range, right? So that is what ranging means in the forex market. Uptrend simply means that you have this price is constantly going up. Let's use a situation of where we started fresh fuel and gas scarcity early this year. I think it's early this year or some period last year when our president just stepped in. So we start fuel move from 250 naira to 300 to 500 to 700 to 1,000, and this was constantly going up every single day, every single week. So that is a significant example for an uptrend. It means something's always going up. Price of an asset is always going in a trend, which is upward. It's increasing in value. It's increasing in value, right? The same thing goes to the opposite side where we talk about downtrend. When we mention about downtrend, it simply means that an underlying value of an asset is going downward, depreciating. So appreciating, depreciating, um, is what that means. So this gonna be some of the vocabulary we're gonna hear. So we also talk about consolidation. Consolidation is the same thing or another word for ranging in the market. So when we mention consolidation, we are also talking about ranging in the market. So we move forward from here, guys. I hope you guys understand that. So let's see a clear example of what we mean by that. So look at this. Um, when the market is going upward, when we are buying, when the market is going upward, which means the market is moving from one price to another price, increasing in value, and in some cases, we call that nature of the markets a bullish market. So we are getting into some certain things now. We're going to be hearing some different language. Okay, so a bullish market simply means a market that is going upward. It's the nature of the market that is breaking price levels and is going upward. It's making its way upward to the base or premium price ever attained to. Let's say something like Bitcoin right now. Currently, Bitcoin has been in a bull run, What that means is that he has constantly been in a market condition where it's appreciating. Everybody's speculating higher prices. It's constantly breaking price. So it has been in a bull run for some time now, right? You can hear something like a bull market. You can hear something like, a bullish market. Simply means that market is simply going up, or that asset is simply going up. So in a case of a bullish market or a buy market or an uptrend in the market, you want to buy where the trend is yet to move. What I mean when the trend is yet to move. So you will hear a simple terminologies in the market like buy low, sell high. So buy low, sell high. So what that means is you want to position yourself where you buy a certain underlying asset when price is lower. So you buy when price is lower in speculation that price is going to go higher. And when price now start going higher, that's when you make profit. So the same thing it is. Like right now, if you're trading BTC, which is already trading at a premium price, I think 100 and something or 190 something $1,000, right? Price is already very expensive. So if I'm trading BTC right now, technically I will likely be looking for more of sells because I'll be expecting price to fall. And we'll talk about that more in more technical forms, what we call pullbacks, retracement, for price to go back higher. So what that means is that if price is too expensive, something is too expensive, the market currency pair has already been on a bull run for a certain period of time. People start speculating a sell off. People start speculating a bearish market. It means that you start speculating a reversal where price will start selling off, devaluing, and all of that. So take note of these two market conditions: a buy market and a sell market. So you want to buy when price is lower and sell when price is higher. So that is the scenario. So the difference in this price is what you're going to make your money in terms of the buy price and the sell off price, and in terms of the sell price and the buy price. So the entry price and exit price is going to determine how much you can make when you engage in trading the forex market with um, a certain currency pay and all of that, or assets. So now look at this. We talk about we define ranging, what it means before. Now look at this. We have what we call the ranging market. So what that means is that the market that is going sideways, consolidating, indecision has been taking place in the market where people are not, willing to buy or sell above a certain price level, and you start having price pattern form there, which is consolidation, where price will maybe buy up to, like, let me use a case of BTC for example. Currently BTC is trading at around $110,000, and then so between $110,000 and $100,000 has been in a range. So what that means is um, BTC has not break above 110,000 and has not really traded below. I think has not traded below 100,000 in some weeks now. So what that means is it has created a range. People are not willing to buy more when it gets to 110,000, and people are not willing to sell more when it's trading around 100 and something thousand. So that created a range, a price range, where we have where it now created what we call support and resistance. So we now have a resistance level where people are not willing to buy more, and we now have a support level where people are not willing to sell more, right? So that is just about the ranging market. Let's continue. Now, let's look at how an uptrend is being defined, right? What really makes up an uptrend in the market? How do we determine if the market is going up, if the market is going down, right? So in a structural form, in a market nature, how do we determine that? So if you have a question, just hold on. I will give opportunity for you to ask the questions. You might as well write them down so that you don't forget. So let's talk about uptrend, how it's formed, or how do we derive uptrend. So these are just illustrations. We'll get to charts at some point, and you'll see practically how this is formed. So, but take note of what we are discussing right now and pay attention to it. So when we talk about an uptrend, look at the staircase, for example, something like a staircase where from one step to another, one step to another. So in a staircase, you constantly have to retrace your step before you keep on moving forward. So if you're descending, in the case of uptrend, you're ascending. In the case of downtrend, you're descending, right? Like you're coming down from a staircase. So there are levels that you need to take one step to another, one step to another, and that forms you that descending or ascending form in if you're moving forward or moving backward. So now, in the case of uptrend, when we talk about the market is going up, how do we really determine by nature that this market is really going up? By nature, this market is really coming down. It's what we call swing high and swing lows. So every market is going to create what we call swing high and also going to create what we call a swing low. And how do we really determine that? Look at this. In the case of an uptrend, we said you want to buy low and sell high. So an uptrend will always form what we call a low, initial low, and high. That is the basic thing. Anything you will find in the market, there's always going to be a price, which is a lower price and a higher price in anything. Just like I was using the case of rice. There are places you go, you buy it lower. So there's a lower price, it's also a higher price. So which created, a swing high and a swing low in the market. So in this case, for an uptrend, you're going to have a low and you're going to have a high. And then you're going to have what? A higher low, and you're going to have what? A higher high. And also going to have another higher low, another higher high, higher low, higher high. Let me explain that again. Now, what that means is there's a low that was created, or there's initial price which form a low, and there's a higher price. So the higher low means that this low is higher than the previous high and is higher than the previous low, but it's still a lower price because price intentionally is going to create another high that is higher than this low. So what that means is, let me see use the case of petrol or fuel pump in Nigeria at this current price. So there was a time that we bought a liter about 750 naira, and there was a time that we bought at 500. So what is the low at that price? Initial low was about 250 naira. So that was the low in the market. That was the lowest price, and you could consider that low to be this way. If you look at the screen, you'll see this my mouse, where my mouse is, the face low. And what was the next price? The next price is that we sold at $500 or 500 naira. So now that created a recent high, which makes a high in the market, a swing high, a swing low. And the next price was about 650 naira. So 650 naira is higher than 500 naira. So that created what? Another high, ascending in nature. And maybe after 650 naira, we sold about maybe 550. So what that means is price, started retracing. It's what we call retracement. Where people start complaining and maybe started protesting and all of that, they now bring the price. They went to union, all of that, or maybe agents and government agents started locking down filling station. If you're not selling at this price, they're going to lock down. So people start bringing their price back, and then they sold it at 550. So 550 is higher than 500, which was the previous high, and 550 is higher than the previous low, which was 250. So that makes it what? A higher low, because it's still a low price compared to the new price, because a new price was created, which was 650 or 750, and then it's now selling at 550. So it's lower than the previous price. It's lower than the recent price, and then it's higher than the previous price. So that is how uptrend is being determined. I'm trying to break that down in a very simple and a layman's language, right? So, but take note of this, that in every uptrend market, you want to see what we call a low, you want to see a high, you want to see a higher low, you want to see a higher high in the market, you want to see, a higher high, and you want to see a higher low. This nature will form an ascending nature of market. So look at that in other forms too. So now look at this chart. If you look at this chart now, you'll see what we call candlestick. I haven't mentioned that yet, but I'll talk about that later on. So candlestick is basically what we use to analyze price. Like I mentioned, that technical analysis, you need tools like price indicator, trend lines, moving averages, and all of that, volume, data to be able to analyze. So candlestick is one of those price indicator that we use to analyze price movement. So I will explain the nature of candlestick later on. So this is a simple nature, what we just described here about higher highs and higher low and all of that. So if you look at this now, this is an uptrend in the market. If you're familiar with charts, this is an uptrend in the market. It's not going to be a perfect diagram, So, but what that means is that this price started from, this is a low and this is a high. So at some point, this was a high. At some point, this was a low. Created a new highs around here, created a new low, created a new high price, a new low. You see that this chart has two colors, which is white and black. So the white one is showing when the price was going up, and then the black one is showing when price was coming down. Practically, we're going to illustrate this again, but this is the nature of which the market moves. The market is going to move from a lower price to a higher price, or it's going to move from a higher price to a lower price. And the difference in this price is where you're going to make money from. This is not complicated. Don't get it wrong. If you have questions, please write the question down. We're going to attend to all of that. So the same thing happens here on a lower trend or a downtrend and all of that. So we have something like a high, and then we have a low, and we have a lower high, a lower low, lower high, a lower low, lower high. Remember the case of me talking about you coming down from a staircase, right? So you're already at the top floor of the building, and you want to come down to the last floor of the building. So what that means is you're already at the higher price, and from each step you're taking is taking you lower, and also creating the steps to take you to the lowest price or the lowest floor that you're actually heading into. So in the case of a downtrend, you want to sell when it is high, and then you want to exit at the lowest price, because that is when you're going to make profit in the differences. So moving forward, we have a high, a low, a lower high, lower low, a lower high, a lower low, a lower high. So this is going to form your strategy, because you want to understand the nature of the market so that you'll be able to know when to make your trade decisions, either to buy or to sell. So all of these things that we're doing, we are doing it for just two things to happen, to make just two decisions, either to buy or to sell, or not to do anything at all. So here we go. So this other chart has two colors, which is red and green. So anywhere you see green color, it means the market is bullish. By the way, you can customize your charts to what color you want, but there's a significant color that is popular in the market, which is the green and the red. So the green simply means bullish, and the red means bearish. The green simply indicates buyers in the market, and then the red simply indicates sellers in the market. So that is how you use it to analyze activities and price activities in the market. You will hear something like price action. So when we're talking about price action, we're talking about the activities in the market. And we use candlestick analysis to be able to read what buyers and sellers, market participants are doing, volume, sell-off, willingness, unwillingness, support and resistance. All of this, you're going to, use candlestick analysis. Is the popular chart and the popular, indicator, price indicator we use in trading. So you can look at this now, that this price, this is the highest price of this chart. This where this my cursor is, and this is the lowest price of this chart. So you can see that this price has been descending from the highest price to the lowest price, but it doesn't come in a straight line. It's forming exactly what we just talked about right now, which is a high, a lower high, a high, a lower high, a high, a lower high, um, a high, a higher low. Sorry, I mean a higher low and a lower high, and all of that is just going back and forth, basically forming this price nature, right? Sorry to say. So this was a low, a high, a low, a lower high, a lower low. Sorry, so I think I mixed that up for you, but you can understand what I'm trying to say here. So let's get to where we talk about the consolidation. So I mentioned about price consolidation before, or indecision in the market, or a ranging market. This is a typical example of an arranging market. So you can see where we have this rectangular box here. Price is not creating any higher highs or higher low. It's not creating any lower price. It's not creating any higher price. All the price does is you come back and trade a certain price level, which is the range, and go up, trade the range, come back, trade the range. And we have something we call a breakout. So when we get to more in technical analysis, you understand what different types of price breakouts, right? So when price is in this kind of situation, it means that there are unwillingness of buyers and unwillingness of sellers to engage in that market. So price is going to be trading in a range, and there are different factors that contributed to that. Different factors contributed to that. So understand that these are the nature of the market you're going to see. You're going to see an uptrend market. You're going to see a downtrend market. You're going to see a consolidation market, a ranging market. Consolidation and ranging are the same thing. So three nature of the market you're going to experience when you become a day trader. You're going to experience this on a daily basis. So you pay attention. So this might look a little bit advanced. Please, guys, if you missed the previous class, you have to go back because we started all the basic. We are just started getting into something that is much practical to see. Right. So let's move forward. And yeah, I did not mention this. So when you're trading a ranging market, at least people have a strategy to trade a ranging market and make profit. So you can trade the ranging market and still make profit. Simple strategy is buy high, sell high and buy low, sell high and buy low until you have a breakout of either the upside or the downside and you join the trend. So, but there's a nature of the market that people don't even trade at all, which is what we call a chubby market. A chubby market it doesn't create any price barrier. It does not create any support, does not create any resistance. It does not create anything. So it's simple. It's gonna, create support and resistance, and then now sweep it up by a fake out, create another support and resistance, sweep it up by a fake out. So everything is just choppy. There's no structure. You cannot see swing high, you cannot see swing low, you cannot see higher high, you cannot see higher low. And that way, it is impossible for you to trade that market and become successful. This is the most market people lose money the most. Any market nature that you're seeing this kind of thing, best advice is run. Just leave that market for that day. Just leave it till there's a trend. The trend can either be up or be down. So if there's no trend, you don't want to trade. And if the market is consolidating, we are having ranging markets. If it's not creating a very clear support and resistance levels or patterns, you don't want to trade that. And if you don't even have a strategy to trade that kind of nature of the market, you don't want to trade that. So let's move forward to trend is your friend. So when we talk about up, down, trend, and all of that, what does it really mean? Trend is your friend. What that means is a popular saying in the market. You will hear something like ride the trend. You want to ride the trend. I want to join the trend. So either the trend is a bullish or a bearish trend. Your job as a trader, most likely a retail trader, is to follow the trend. Follow what is trending. That's what it means. So because like we laid our foundation before that, the retail trader contributes only about 20% of price movement. So the big players are the banks, are the large commercial institutions, are the other speculators, hedge funds, managers that trade millions or billions of dollars. Those are the kind of people that move price, because the market works based on price, based on volume, based on participants, based on liquidity. So that's what makes price move from one point to other. It's a simple theory of supply and demand. The same thing that happens, in commerce and all of that. When you talk about supply and demand curve, when the demand uh, when the demand is high, price is going to eventually go up. When the demand is low, price is eventually going to do what? Come down. So that's what it is. When there is enough volume in the market, it's going to move the market upward. Enough demand in the market, supply and demand levels. We'll talk about that. There's going to be that's going to make price to go up. So when there are no demands, or when there are excess supply in the market, price is going to come down. So that formed the trend that we're just talking about now, which is the buy and the sell trend, upward trend, downward trend in the market. So you hear something like in the world of crypto market, you hear something like people saying, buy this crypto now, it's gonna be bullying, it's gonna pump, buy and keep, it's gonna pump. So what you're simply doing is you're positioning yourself for that bull run or that pump that is gonna come, and so you're actually following the trend. And you hear other speculations like, oh, this crypto, this coin is going to sell off. If you have it, sell your off your price, convert it to a stable coin, and all of that. So you want to stay in the market and understand the nature of the market you're trading. Is it an uptrend? Is it a downtrend? Because your job as a trader is to follow the trend. Why you have to follow the trend is that you don't have that liquidity to be able to move price. So your order that you're filing in the market, your buy order, your sell order you're filing is you cannot counter any order. So if the market makers are or the volume is going on the buy side and you're trading the sell side, what you're trading cannot change the direction of the market. The only people that can change the direction of the market are the people with the liquidity, are the market makers. They are the big banks. They're the only people that can, dump and pump the market, for example, right? So central banks, maybe intervening in one or two things and then changing, buy one currency off another currency to stabilize the economy or whatever it is. And they can redirect price and redirect markets, and all of that. So that being said, let's talk about the nature of the candlestick, because I didn't introduce that earlier on. You guys just slide into a chart and you're seeing I just mentioned chart and the candlestick for the very first time. So candlestick on its own is a price indicator, and we use that to analyze the market. So one candlestick is just a candlestick. So you need more than one candlestick to be able to form a chart. From forming a chart to be able to form a nature, a structure. From forming a structure, you now have an idea of what is happening between buyers and sellers in the market. So because that is what we're dealing with, right? So what is candlestick? Candlestick is simple and a price indicator. The history says it was introduced by a Japanese, either a Japanese or a Chinese man, um, you know, to enable quote price in the market and to enable analyze price in the market. And since then, he has been the most adopted chart form, or instrument to use to trade the markets, more like worldwide. So we have different forms of charts. We have something like bar charts. We have something like wave charts. And then we have the candlestick charts. Yeah. So, but the most popular form you're going to see is the candlestick chart. So this is called a candlestick. So why is it called a candlestick? It's because it has body like a candle. You can see a candle here. This body like a long candle, and you also have this other one like the candle wick, where you light your candle and then you start burning. So that is simply the nature of it. So I think let me just give this chance for. I think somebody lifted up behind. I thought you wanted to ask a question though, but let me continue. Write your question down. We'll soon take questions and we'll know where to end the class so that it's not going to be that long for you to digest. So this is the candlestick anatomy. You want to understand how the candlestick works, the opening price, the closing price, and all of that, so that you can know how to use to make your trade analysis. So this information I'm giving might look piece by piece, maybe doesn't really make sense, but it's going to make sense later on when we start applying this information on the chart. So you have an idea. So every candlestick has what we call an opening price and has what we call a closing price, and it also has what we call a high and a low. So take notes: opening price, high, low, and close price. All the candlestick has these elements, and people use this as a strategy where the market opens, where the market closes, and to make trade decisions. It's a very significant thing that and all of that. So let me go up. So for every candle that opens, this open price simply means that this is the initial price. So take this candle to be a neutral candle. Forget about the fact that it is green. Let's say it was not green, it was not blue, it was not red, it was not green or black. So like we said, the candle has like two colors. You're gonna have either green or red, which means you represent the buyers or the sellers. So the color is gonna form on your chart after you set your primary color for buyers and sellers. So the color is going to form on your live chart is going to be based on the price activities, and it's also going to be based on the opening and the closing price. So what that means is, if a candle opens, it's going to open like a neutral, and if the buyers are stronger in the market, it means that that candle is going to start going upward, which is going to make it what? A bullish candle. So we have a bullish candle and we have a bearish candle. The same way we have a bullish market and a bearish market. So when the candle opens and the price go higher, it's going to form what? A bullish candle. And when the candle opens and the price goes lower, it's going to form what? A bearish candle. So the opening price will determine what nature of candle is going to form. And the nature of candle is going to form is based on the volume, where the pressure is going in the market. Is the pressure going to the buy side or the pressure is going to the sell side? So after the market opens or after a candle opens, the next thing is, where is the pressure going? If the pressure is going to the upside, it's going to form a bullish candle. If the pressure is going to the lower side, it's going to form a bearish candle. But until this candle also closes, we cannot also ascertain that this is a bearish or a bullish candle. So you have to wait for a candle closure to determine what kind of candle it is. Is it a bearish or a bullish candle? So in that case, the opening price is important and the closing price is as important as the opening price. Please take note of that. The opening price is important and the closing price is important as what the opening price. So what that means, the closing price is really the determinator factor of what's going to be formed in that. So if the candle opens neutral and it goes up and closes higher, it's going to form a bullish candle. And the candle opens and the pressure goes to the bear side and it closes lower than the opening price, it's going to form what? A bearish candle. Now, how does the wick, this thing that is here looks like a pen, is called wick. How does this wick being determined? How does this wick determine? So what this means is, this wick is an indicator that shows you the highest price after the opening price and the lowest price after the opening price. So the highest price has gone to after it was open and then closes, and the lowest price have gone to after it has opened and then closes. So in this candle right here, let me explain what has happened to this candle right here. And without telling me that this candle is green, without telling me that this candle, without having this color to be green, I can tell you by giving me the opening and the closing price, I can tell you the nature of the candle, what it is, because that's all what you need. You need the opening and the closing price to know. So now let's look at this. Now this candle opens here, and then what is telling me here is that at some point after the opening price, that this candle went up and formed a higher price, but then did not close within this interval or within the price interval or within this price range, or did not close above the opening price, which would have made it a higher, we could have made it a bullish candle, but rather it came back to its opening price, which what leads to forming this wick, this long thing you're seeing here. And then it went low and went low and went even to the lowest price. So this was the lowest this price went to. And it did not also close here, either by price pressure, maybe the bullies or the bulls in the market step in and then start pushing the market upward again. But eventually, within the opening interval and the closing interval, it could be a 1 hour time frame, it could be a 2 days, it could be a 1 month time frame, it could be a weekly candle, it could be a daily candle. So between the opening and the closing of the market, or the time which you're trading the chart, you're using the chart with. So if it closes within that time frame and then now closes here lower, so this was the opening price and now closing lower, so that naturally makes me understand that this is what the bear candle means, that it's a bearish candle, and then what that means is it's going to form a color red. So this color is supposed to be red in a real sense. This is supposed to be red, because it opens there and closes what? And closes below. So that gives me the nature of what has happened in the market. So I can say that, it means that after the opening price, there was a pressure on selling of the market. People were selling the market more because it closes on a lower price. Closing on this is the highest, this is the lowest, but still it's lower than the opening price. Where it's close, it's lower than the opening price. So I want to believe that you guys grab that, you will understand more and later. So like I mentioned, that the candle wick, the body, everything, the opening price, the closing price, the high, the low of that candle is a significant indicator to technical analysis. It's a very significant indicator to technical analysis. So you have to understand how it is being used to determine or being used to make trade decisions. So now look at this. We have this candlestick here. The big fat portion, the wick, also known as the exhaustion or shadow. So this is also known as wick, exhaustion, shadow, or it's also called rejection, right? And we have this big side called the body of the candle. So there are different sizes of candle where you're going to understand the different size, because the candle different sizes is what make up the chart. You have different patterns of candles, how it form, based on opening and closing price. After analyzing just one candle like this, you now have more than one candle to three candles. It has a pattern. One or two candles can form a pattern, and more than one or two candles can form a nature or a trend. But right now, you cannot really determine with one candle like this. You cannot really say this market is either trending upward and trending downward. It's just a candle. It's just showing you price impact. Either it's bullish or bearish. But you cannot really say it's really trending because there's no nature. So when you have more than one candlestick, it now make more sense because it's giving you what we call price data. It's giving you history of performance of that asset. You can read the price based on the cluster of those candlesticks that you have on your chart. So the wick of the candle is very important to a technical analyst because it significantly tells what has happened in the price. In most cases, we use them as a rejections, showing that price, people are unwilling to go above that price, or people are unwilling to go below that price. So it tells us a story of what has happened, what buyers and sellers did there, right? So wick, take note, wick is important. We'll tell you how to use the wick to trade soon. The body also is very, very much important. So how long is the candlestick body is very important. How short is the candlestick body within a time frame is very important. So on your trading chart, you're always going to have what we call time frame. So this candle is formed, each candle is formed based on a certain time frame that you're trading on your charts. So like this one now, it could be a 1 hour time frame. So what that means is until an hour time from the opening price of this candle, the candle is not going to close until an hour time. That's what it means. So each candle on a particular chart that is like a 1 hour time frame, each of them open and close within an interval of 1 hour. So that's what it means. The same thing happens when you're on a chart that is like one that's like 1 minute or weekly. So for this week now, the market is going to open shortly, maybe in 2 hours from now, and then we're going to have a weekly candle. When price open, the weekly candle is also going to open. So you're going to have an opening price, but that candle is not going to close until Friday night. So on a weekly time frame, all candlesticks form form based on weekly, right? So the same thing on a daily time frame. There's gonna be a candlestick open on, which is few hours from now, as the market is gonna open. That candle is gonna serve as the daily candle for the day. So in the next 24 hours, that price candle is gonna be open. You will see it going up, going down, going up, going down until 24 hours before it finally closes. Then you go into what lower time frame, like 4 hours. Each candle is going to open, closes within 4 hours, and 1 hour to 5 minutes to 1 minute, 30 minutes. So that is how a price chart is being formed. And as a day trader, you're going to trade, make your analysis within all this time frame, but you're going to do more of a lower time frame so that you can have price pattern, nature, structure to trade with. Okay, so which tells a lot about decisions being made in the background. So like I was explaining, that the way candlestick forms is very, very important. So for example, this candle is different from this candle. The candle A and the candle B tells you a different story, a different scenario of what has happened in the price here. Okay, so this candle has big body and lower, small wick, but this one has small body and a very long wick, very long wick. So that shows price impression and pressure. So what I mean is there's a lot of rejection in price here. But this one, there's not much rejection in price. So we'll understand that better, how different candles nature is being formed. So we also have resistance. You use different, candlesticks to determine resistance levels, support levels, rejection level, and all of that. So when you have more than one candlestick, two candlesticks, rejecting a certain price level, that tells us a story that there's a resistance. So consider this black line as a price line. So you can see that this previous candle here came in this price line and then was rejected. And this other one also came in here and rejected, and even rejected even more. So what that tells us is, because of this candle and this candles rejecting this price, they have formed what we call a resistance level. So rejections, candlestick week tells a story in the markets, So you understand more when we get into charts. Yeah, we are here already. So look at this. These are candlesticks, basically. These are candlesticks. So like I told you before, you can make your candlestick different colors. But basically, you're going to have two colors on your chart. One for buy, one for sell. But the popular one you're going to have is red and green. Okay, so that's what you're going to have. So now look at this. Here we have more than one candlestick. So we have buy candle. This is a bullish candle. Sorry. This is a bullish candle, bullish candle, a bearish candle, a bullish candle, a bearish candle. So this become mixed of character, mix of nature, that tells you different price actions in a certain interval of the market. Now, you can see this line that is here, what I discussed about candlestick rejection or candlestick wick, how it's being used. So we have more than how many? 1, 2, 3, 4, 5, 6, 7, 8. Many candles coming into this price, and then they rejected. Price could not hold or break above. Now, as a trader, this is significantly telling you that this is a strong price, because each time the candlestick or the bull candle is coming here, it rejected and form either a bearish candle or give a long wick or a short wick. That shows that this were we have a resistance or people are unwilling to buy or sell in the market. So I've been talking about resistance and support level. I've not really explained what resistance means and support means. Well, but just have an idea that there's something like that. We'll talk about that later, how it's being used in a strategy form to trade. So yeah, now in a case of an uptrend where we have a candlestick wick form, more than one candle, more than two candles, more than three candles, it's going to form what we call a resistance level. Take note of that. But in the case of a downtrend, and we have more than one candle wick, two candle wicks, three candle wicks, it's going to form what we call a support level. So what is support level and what is resistance level? Support level simply means that it's a price level where we have more buyers than sellers. A resistance level is a level where we have more sellers than buyers. So this form volume and this form pressure in the market. Understand that the market is moved by these two players, the bears and the bulls, the buyers and the sellers. So, and the price is going to go in one direction, either uptrend or downtrend, depending on the market participants and depending on the volume that is going, the amount of volume going into one side. So if the volume that is going into sell side, or let me use the word money, if the money on the sell side is bigger than the money on the buy side, price is going to go what on the sell side. So it's a battlefield. That's why you see most forex icons or symbols, it symbolizes a fight, bulls and bear. It's the market is a fight where this one said Nami could carry him, that one said Nami could carry him. You understand? So whosoever is more like a talk of war, something like that. Whosoever is overpowering, and to overpower anything in the market, it's simply liquidity, liquidity volume, which cause volatility in the market. So when we have more liquidity and more volume, that is where the market is going to go. So the sellers and the buyers are the participants that decide the price movement, right? So if there are more sellers in a certain price, like I explained about supply and demand, if there are more people demanding, it means that price is going to go up. But if there are more people supplying, too many supply, and not much demands, it means that price is going to go down. So that is what it means here. For every resistance level to form, it means there's a lot of supply level. This is also called a supply level, where we have more sellers. And when we have more sellers, it means we have more people that are unwilling to buy, but we have more people that are willing to sell. I'm trying to explain all of this in a layman's language. So I want to believe that you understand me so far to this point. So moving forward, I talk about support level. So the same thing on this downtrend. So in the case of a downtrend, support level is formed when you have more than one candlestick rejection, more than one candlestick weak. It forms what we call a support level in price. And what that means is that we found on a support level, we found more buyers than sellers. And it's also more like a floor side where something is rebounds on an area. So I want to hope you grab that. So this is more a typical example of a support level as well. So this is a price line, and you can see this price came in here, bounce. This one came in here, bounce, and then what that shows us that there is what a rejections around this area. So you need like to determine a support or resistance level. You need two things in particular. You need at least two swing high or two swing lows. Remember what we talked about swing high and swing lows the other time, where we have higher highs and higher low, lower highs, lower low. This is exactly what is playing out. So in this case, we have two swing lows. This is a low. This is a low. This is a lower price, and this is a lower price. And it's also a swing low, a swing low. So you need at least two swing lows to form a support level, and also need at least a two swing high to form a resistance level. Just like here. Now we have this is a swing high, this is a swing high. So these two put together, two or three, will form a price level either a swing high, a swing low, or a support or resistance level. So, guys, don't panic. This is just small thing that you guys just need to understand. When you start trading, this information is gonna make even more sense. So, I'm trying to give you an insight of what we do on a daily basis as day traders. The simple thing we do is we analyze price, where it's gonna go, and the tools we use is candlestick charts, and these are the element of things that we look in. So do you want to know all of these basics so that you can put all of this information together and form what we call a trading strategy? So what I'm doing now is simply different from trading strategy. I'm just giving you a breakdown of what the forex market, what you will eventually see in the forex market. So what I'm talking about now, go to India, go to Pakistan, go to UK, go to US, you're going to find this is a universal knowledge. So you're gonna find the same understanding. So these are not the basics. That's what's gonna form your your strategy eventually as you move forward. So we've already spent an hour on this class. So we might like to come to an end of this training of this class on this topic. So on the next class, we're gonna start from market orders. Buy stop, sell limits, buy and sells, and all of that in the market. So now you fully understand how we derive or how we end up buying a certain asset, one currency against another, by looking at your candlestick charts, using price indicator, technical analysis. What I just explained there is basically more of technical analysis. So then on our next class, we are going to talk about some other vocabulary, something like buy stop, sell stop loss. We hear something like stop loss. We hear something like take profit, and yes, some of those, vocabulary, and you want to use them to make, trading decisions and use them to make orders. So basically, we'll talk about trading orders. So let me take question. So I'm going to unmute. If you're being muted, Glory James, you're just joining us for when we are about to close. You came late, but I think if you have questions, we're going to attend to it. So I'm allowing you guys to be able to speak. If you're being muted and you have question all this while on this topic or previous topic, I would like to answer that question right away. So someone with question? Is there any something you did not understand? Hello. Jeff Carter, Coach Victor,
Good
Chike,
evening.
El Madi. Is there something you don't understand? Big Vance, Team Smile, Odofia.
Hello, sir.
Yeah, I'm with you. Go
Yes, sir.
ahead.
Good evening, sir.
Good evening.
Thanks for having us. It's wonderful. Class.
All right.
Hello, sir.
Yeah, I can hear you. Go ahead. I'm listening.
Yes, sir. I would love to ask some questions, but I'm on transit now. So I think if it is okay for me to shift the questions for our next session, next class.
Oh, okay, so you want to ask about what?
Good evening, sir.
Oh yeah, Jeff Carter. Oh yeah, go ahead. I'm listening to you.
Okay, sir, I did not understand the previous calculation on pips we did the last time,
Okay.
so I'm still confused about it.
Oh, okay. So, I where did not get it right, because I think that's one of the simple calculations in the world. So let me explain once again. When you want to calculate pips, you have to understand what pips stands for in the first place. Pips is
Okay.
the unit of measurement in forex. where we measure price movement. So if you want to determine how price have moved from point A to point B, you measure it in pips, right? So what that means is from point A to point B, just like you measure distance, you understand? Um, you have to use pip value. So if you tell me, oh, today market was so volatile, today market was, you know, AUD USD has done 25 pips. I understand how much value that market has given for that day. Or Europe USD or gold have sold for like 100 pips today. That is crazy market for me. Like, wow, gold deliver 100 pips. So I can use that point and calculate how much money I would have made in the market if I was trading that market. So what you basically need when you want to calculate price movement in units, which is in pips value, you need entry price or exit price and exit price. I mean, entry and exit price. Now, in the case of the entire market volume, in the case if you want to calculate entire market volume, you want to calculate from the opening price and the closing price. So if the market was bearish today, you look at your daily candle. Where did the market open? Okay, you open at 500 naira. If I'm in the case of naira, where did the market close? The market closed as 2,500. Do you understand? So
Yes, sir.
from 500 to 2,500. So that is your entry price. So you take 500, subtract from 2,500. You divide that by 0.001, and that's going to give you your pip value. So the standard form of pip is 0.001, which is the four decimal points on your price symbols or whatever, or your quotes, the four decimal points. So you take the entry price with the exit price, or you take the opening price and the closing price, subtract these two. It either is going to give you negative or positive depending on where the market closes. So if the market is a bull market, that means exit price is going to be higher than the opening price, or closing price is going to be higher than the opening price. If the market is bearish, it means that the closing price is going to be lower than the opening price. So either way, it might give you a negative figure. But what you do is you divide that by 0.001, and that's going to give you the actual pip value of that price movement. Is that understood?
Okay, sir.
Yeah. All right. Thank you very much. Anyone with another question? Anyone with another question? Okay, so I'll assume there's no more questions. So what's going to happen is, if you have more questions, please you write on the discussion group. Check the channel that you're in. You can write a comment, and there's a separate group that you can write a comment on. Just join that group. You can write comment, ask questions. That is a public group where everybody can have freedom to write, post their chats, their trading history, and all of that. So first of all, I'm going to thank you guys for staying from the beginning of this class to this point. I think this is one of the longest class we have had so far. We have already 20 minutes, beyond our time. We're supposed to have stopped by 9 o'clock. But don't leave yet. Don't leave just yet. There's some announcements that we have to give for you guys. So tomorrow is Monday. The market is opening today, and tomorrow is Monday. And then we are trading every single day. So we trade every day. At least one signal is always dropped on our channel where you can use that and make money for yourself. Now, the essence of having this training is not to leave you behind. And this training is being conducted for free. So the best thing you can do yourself, I encourage everyone, is always go back to this training. Get an understanding. If you're here for the first time and you missed the previous class, don't do that thing we used to do in secondary school or maybe university. When you skip the class, you said, after all, I don't skip, make I just join them, they go. If you miss the basic fundamental, all these things we are talking about, it's going to be difficult for you to understand where we are coming from, because it's one thing leads to another. Everything is connected. Every information is important. As small as it is, it's important for you. So go back, listen to the Forex Foundation session 1, Forex Foundation session 2. All of that was hold this period, was hold this particular month, and listen to Forex Foundation. Come back to this training, and this video is going to be up on YouTube. You go back and listen carefully so that you can come back with questions on our next training, right? So that's what I'm asking you to do. Then another important thing, which I think I'm going to hold a separate section either in the middle of the week to explain some certain things and talk to you guys one-on-one. Again, because I think this time is not going to be enough to continue with that. We're going to have a community virtual meetup eventually one of these days. Maybe before the next class, we should be able to have a virtual meetup so that I can explain some of the things you need to know and you need to do to become a trader, to become a consistent and a profitable trader, to even make money from this industry. So today might not be for that day. I would just like to pause it for here. But every other instruction that's been given on the community, please do well to follow those instructions, because your success lies based on the instructions you're able to follow. We're not going to lead you astray. We are here to guide you, and we are here to support you. So programs is going to come. We'll talk about some of those programs that are going to come to help support the community in terms of trading activities, funding, making profit, and all of that. Copy trading, automatic copy trading is going to come. We are setting everything up before the first quarter of the year is over. We're going to make things very easy for you guys here in the community. So there's a lot to be benefited from here. So please spread the good news with us. Share our signals, share our community contents with others. Let them come and also benefit from what we're doing. And my appeal this night is going to be, after now, I'm going to drop a Facebook post. I'm going to drop a Facebook post, a link on the community. What I'm going to request from you guys is to support us. We're running a campaign on Facebook, and we want to be able to reach as much people as possible that are interested in learning forex. We are not charging anybody, so don't think that we are going to be making money off of them. So the only way to support the growth of this community is to share our content, write a review about this class and make a comment. And the best part of it, that we're also going to have a reward to give the best comments and the best review that we have on that post. So just do that to support us. Let it be a give back on one way or the other for spending all of this time trying to put this together. So for the people that take part last week, we promise we're going to take at least 5 persons to reward a cash prize. So we're going to do that after now. We'll select at least 5 persons, and from the post that we drop and the comment section, the best comments, and then we now reward them for supporting the campaign and supporting the community. So guys, thank you very much. There are great opportunities here. You're always welcome. And for everyone that's joining us late, please, after now the video is going to go up, the content is going to go up, you can go back and replay. So I would like to take this time out and say thank you guys for staying for this long. It's time to draw the curtain. So good night,
thank
traders.
You, sir.
And yeah.
Thank you.
Yeah, thank you very much. So more information on the group, comments, and write whatever your requests are. Thank you guys, and have a good night.
Good night.